Hi everyone, my name is Alex and welcome to my YouTube channel. If this is your first visit with us, then welcome, and if not, then welcome back. Today I'm talking about business structures, and it is a massive area of advice for us in the practice. Because it's such a big area, I wanted to be able to do a video just to help everybody to understand, because clearly everybody wants to know all about the different business structures and how they work and the pros and cons of different business structures. So I'm going to be running through what the different types of business structures are, and then I'll just briefly go through the differences between all of them and what they all mean. Then we will have a look at the most common ones that we see coming through. We will look at how you change structures, what the applicable tax rates are, and whether or not you can combine structures. Okay, so let's start this off by saying what are the four key types of business structures in Australia. So the four key types of business structures are sole traders, partnerships, trusts, and companies. Let's start with the sole trader. They are by far and away the easiest structure to set up. They are simply, you go and get an ABN, so someone like you or myself, we would go and get an ABN. We then can hang the proverbial shingle out the door and go off and start working in the business. We would always recommend that you have a separate business bank account, but aside from that, that is the barrier to entry. There is nothing else there at all. It is easy, it is quick, and it is cheap to set up. The next business structure that is available is a partnership, and there are actually two types of partnerships. So you have what's called a legal form partnership and you have a common law partnership. Common law partnership is where a mum and a dad decide to go out in business, and it could be, brother and sister, but two people decide to go into business together very informally, and they just go out and they start business. They get their ABN for the partnership and off they go. There's no agreement, no nothing. They just go out and they start working. In this instant, we have to distribute the profit equally between partners. There is no way to change that in any way, shape or form, which can be a bit of a negative when we're looking at the overall tax load on the group and the family group as a whole. The other type of partnership is a legal form partnership, and you tend to find these are between people who don't necessarily know each other quite so well. So again, two or more parties going into business together, but you will find that there will be a legal agreement that will dictate how the partnership will work. It will dictate everything from how everybody has to behave in the partnership, how much they receive as part of the profit share distribution at the end of the financial year. It will dictate who can be in the partnership. It will even dictate how you get to leave the partnership, or if something happens, like say a partner dies or something goes wrong, it will dictate how their share in the partnership is to be treated and handed over to the other partners. It's quite a solid way of doing things, and it means that if something should go wrong, then everybody can walk away having adhered to the partnership agreement and not let their emotion get in the way of the distribution and the dissolution of the business. The next structure is a trust structure. They are very, very common in terms of their popularity back in the 80s, 90s and the early 2000s, but they're very similar in the way that they behave to a partnership. So a partnership will have its own tax file number and its own ABN number. It will lodge a tax return, but it will not pay tax. The partners have to pay tax. The trust is very similar in the sense that it will earn money, it has its own ABN, it has its own tax file number, it lodges its own tax return. The trustee will only ever pay tax if the profit is not distributed to the beneficiaries in full. That's the only time the trustee will ever pay tax. The trust is more of a legal agreement. It lasts for about 80 years. You can't just go out and say, I have something on trust. You do actually need the legal documentation in place to be able to do it. Once you have it, you can actually use it as a business or an investment structure, or both. Now, trusts honestly operate better as an investment structure than they do as a business structure. That's not to say they can't be used as a business structure in the long run. At the end of the financial year, all the profit is distributed out of the trust to all the different beneficiaries, and at that point in time the beneficiaries are taxed on the distribution that they have received and the trust does not. The downside to this means cannot keep money in the business to be able to expand going into the future. That's a real downside to a trust structure. The last structure is a company structure. So companies are far more formal in the sense that there has to be a legal agreement in place to do this as well. It is called the company constitution, and all the activities of the business have to adhere to the company constitution. It's the most expensive of all the structures to set up, but it is my personal favorite simply because it has so many benefits. The way that a company works is that it is actually its own entity. So it lasts forever. It doesn't have a finite period of time until it expires. It has its own presence, its own tax presence. So again, it has its own tax file number, its own ABN number, but it also pays its own tax, which is great if you're the business owner because it means you can really manage your overall tax profile. At the end of the year, any profits that are left in the business can either be retained for capital expenditure or they can be paid out to shareholders by way of a dividend. The other positive of a company is that you can actually have a bit of creditor protection between you and your creditors. So if you work in an industry, say like the building industry or the broader construction industry, you are in quite a high risk industry. You may want to have a degree of protection between your business and its trading entity and your own personal assets, and the company does that in spades. The most common type of structure, hand on heart, that we see in here at the moment is the trust structure, but a lot of that is a legacy position. So that is where people have set their businesses up in the 80s, 90s and the early 2000s when trust structures were really the most favorable structure for people to be using. But as the years have gone by and trust structures have been tightened up in terms of their tax profile, and I have done a video on why they're not as popular anymore and why they're not fashionable, which by all means watch it. I will put a link into the description bar below for that particular video. As trust structures have become less popular, we are now seeing more companies coming through into the practice and seeing them come through as taxpayers. So trusts are probably the most common, but they are dwindling, and we are seeing a lot of people wanting to change, and this segues into the section I wanted to talk about around can you change your business structure. Is yes, you absolutely can, and it whilst can be a little bit tricky, there are ways and means to do it. So what we're seeing a lot these days are people moving from sole traders to companies or trusts to companies. And the reason for that is because the tax position in the company is that much more favorable, and there are other benefits such as creditor protection that you have in the company as well. What are the ramifications of changing business structure? Well, generally speaking, there will be a capital gains tax ramification somewhere down the line. I have done a video on capital gains tax, but I did not cover the change between business structures. Usually, if you do transition from one business structure to another, there is a rollover relief from the overall perspective because the overall group isn't changing, it's just a change within the group. So what that means that any capital gains tax that is due to be paid can be deferred until the end point when it's all ultimately wound up, and you don't need to worry about capital gains tax until that point in time. So that can be really attractive in terms of changing your structure now and making sure that there are no tax ramifications or very few tax ramifications in the present time around changing your corporate structure. What are the applicable tax rates? Well, for the first three, they're all much the same. So for a sole trader, you are taxed at your marginal tax rate on the profit that your business is making. For a partner in a partnership, you are charged at your marginal tax rate on your total income that you receive during the year. So if you are a partner in a partnership and you have income outside of that partnership, then you have to add everything together, and then you are taxed at your marginal tax rate on the total. If you are the beneficiary of a trust and you are receiving a trust distribution, then same thing goes. You are taxed on your total income for the year. So that will be the distribution from the trust plus any other income you've had for the year, and then you will be taxed at your marginal tax rate on the sum total of everything. If you are a company, then if you are taxed at 25% if you are considered a small business, and 30% if you are considered to be an investment business or a much larger business. So it's a much better tax rate for a company, which is the other reason why it is so very, very attractive at the moment. Can you combine business structures? Absolutely you can. So what we often see in terms of the older trust structures is we see a trust and then we see a corporate trustee. So that is a company as the trustee rather than an individual. The reason for that is to actually achieve the same level of creditor protection in a trust as you get in a company. Nowadays, we tend to just see companies coming through, but what we do see with the companies and what we advise a lot on is that you have companies with a trust as the shareholder for the company. So yes, you can absolutely have different structures being used together to actually form the best business structure for you and your group. What you may find as well is if you are the type of business that has a lot of assets outside of your trading assets, so I'm not talking here plant and equipment, I'm talking other investment assets, then you may actually consider wanting to have a company as your trading entity and then have trusts sitting off to one side with all your investment assets in, because trusts still receive benefits under the capital gains tax legislation around 50% discounts and things like that. Okay, so today I've gone through the 4 different types of business structures, what the most common ones are, what the fundamentals of each structure is, what the tax rates are for each of the structures, and whether or not you can combine business structures. I do hope you have found it useful. If you've got some more questions for me or you'd like to become a client, then please contact us. I will put all the information you need in the description box below. If you have enjoyed this video and you want to make a comment or you've got suggestions on videos for the future, then please do leave a comment in the comments area. Otherwise, please do subscribe to our channel and hit the bell so that you know whether or not we are releasing any more videos and when we release them. Thank you very much. Enjoy your day.